If you take the word taxes and delete the T and replace the S with L, you get Axel. And that's why I'm the perfect teacher for today's topic. By the end of the lesson, you will know exactly how your investments in Germany are taxed. I know this is an extremely boring topic, but especially in a country like this, where you pay a shitload of taxes, you can also save tens of thousands of euros if you understand just a little bit about taxation. Just enough to use it to your advantage. So let's try to make this as interesting as possible. What's up everyone? Welcome to a new video of PerFinEx, the #1 financial planner for expats living in Germany. Last week, we completed the Magic Triangle of investing. If you missed it, or you don't know what I'm talking about, check the info box right here. Everyone else is a halfway investing expert by now and knows all about bank accounts, fixed deposits, savings accounts, stocks, bonds, mutual funds, ETFs, real estate funds, real estate itself, pensions, all the asset classes you can invest in. And remember, each asset class has its right to exist. This week, we will find out that the Magic Triangle of investing is kind of incomplete because two more important factors are weighing heavy on your return. And maybe some of you out there might think you have a return on your investments, but you don't, because you ignore these two factors. But before we start, let's answer last week's quiz question. So this is a tough one for me. Let's ask my friend Steve for help, because he seems very confident in his ability to invest. We know he's not that smart when it comes to investing, he's not that successful either, but hey, at least he's confident. So Steve, what are you thinking? Duh, it's the product, obviously. I'm not convinced it's that obvious because Amanda showed me a study from the American research company Dalbar. They study average investor return versus average market return and find out consistently every single year that we humans are pretty bad investors. Let's just take the S&P 500 as an example again, because that's what Dalbar is doing most of the time. From 1995 to 2015, the index averaged a return of almost 10% per year. Not bad, is it? The average investor who invested into the S&P 500 averaged over the same period only half the return. How is that even possible, you might ask? Well, Dalbar's data has a pretty obvious answer. The average Steve is trying to time the market and is destroying his own return. Buying high, selling low. The exact opposite what you should do. And then they wonder afterwards why they have such poor results. Last week we determined that investments are usually made for the long term. Dalbar's report says that the average holding period of a fund is only 2 to 4 years. That's not long term at all. So remember, time in the market beats timing the market. So as you can see, you can have the best product in the world and the average Steve will still have a shitty return. I'm not saying the S&P 500 is the best product in the world, by the way, because it's not. That's why I help you to find your personal risk tolerance last week. And the purpose of this whole course is to help you define your very own investment strategy so you don't become a Steve that burns his hard-earned money. I mean, of course you have to invest in a reasonable product at the end of the day, but the right investment strategy is just as important. All investment products that we discuss here are good, but none of them is the universally best for everyone. There's only a right investment product for your goal you want to reach and a wrong investment product for the goal you want to reach. But that doesn't mean that this product in itself is bad. So go ahead, Stevie, just buy random products and have a bad strategy, or no investment strategy at all, which would be even worse, and see how it goes for you. Good luck! Well, on the upside, if you don't make any profit, you don't have to pay taxes. Great transition to come back to our topic today, the Magic Fiveangle. Because the two factors we have been ignoring over the last couple of weeks are taxes and inflation. What inflation is and how it affects you, you can see in this video. Our first PerFinEx explains. For now, let's just say that investing is critical in keeping up with inflation. If you want me to PerFinEx explain other financial terms in plain English to you, let me know. Drop a comment below and I'll make a separate video about everything you want to know. I want to make sure there's nothing holding you back if you really want to start investing here in Germany. So, taxes. Before I tell you anything about it, let me say that we are not a tax consultant. So the following is just education, our personal opinion how we understand taxation, but no tax advice. Please seek help from a tax professional if you have any questions. Generally speaking, the German government wants its share every time someone earns money. Doesn't matter what it is. Except a lottery win, but we already said that a couple of weeks ago, gambling is not the greatest investment strategy in the world. Before we come to what is taxed and how is it taxed, one important thing. Please do not make any investment decisions only for the reason of saving taxes. You hate paying taxes, I hate paying taxes, everyone hates paying taxes, I get it. But saving taxes is one of the biggest misconceptions in the financial world. Because in order to have a real tax saving, you need to get more back in taxes than you put in, which is possible. So putting €1 into something and getting more than €1 back would be a real tax saving. But most of the time, people like Steve misunderstand saving taxes like this. They put €1 into something and get 40% back in taxes and think they saved taxes. Right? But Steve, you realized that you still had 60 cents in costs, do you? So simply investing into something because it has tax deductions doesn't make any sense at all. It's like buying new pants because they have a 40% sale. You didn't save 40%, you still spend 60%. But who needs pants anyway? Germany knows 7 different types of income that are taxed in different ways. Let's start with income from work, because that's what we're all doing. Income up to €9,400 is tax-free. So every euro goes straight into your pockets. Pretty nice. Everything after €9,400 is taxed with at least 14%. Let's say you're earning €10,000 per year, then you would have to pay 14% tax rate on the €600 you earn after €9,400. So €84 in this case. These 14% grow relatively fast up to 42% if you earn more than €57,000 per year. Out of every euro you earn here, you have to give 42 cents to Finanzamt. So the more income you generate, the more taxes you have to pay. That's what we call progressive income tax system. The two big advantages of investment income are that first, you don't have to work for it, and second, it is taxed much better than income from work, except rental income. That is also taxed like work, but stay with me. Real estate investing is still very interesting from a tax perspective. The moment you buy a property in Germany, you have to pay ground tax that ranges between 3.5% to 6.5% of the property value, depending on the state. You also have to pay a notary with 1.5% to 2%, and maybe a real estate agent with 3.57% of the property value. So real estate, to sum it up, has about 10% additional costs at the moment of purchase. If you are investing in real estate and rent it out, these 10% are tax deductible. If you are living in the property yourself, these 10% are not tax deductible. This is the tax implication in the moment of purchase. The running taxes year over year are a little different. Asset rental income is taxed like income from work, so you have to declare it the same way you declare any other income. So if you earn 57,000 euros from work and 3,000 euros from renting out a property, you would have 60,000 euros in income. Bad news is that the 3,000 in this case would be taxed fully with 42%. So about half, including solidarity tax and maybe church tax, is going straight to Finanzamt. Thank you, Merkel. Good news is that you can counterbalance most of the costs you had from renting with the rental income you generated. But again, only for real estate investors, not for homeowners. The most obvious cost is the interest rate you have to pay the bank, because let's face it, who can pay a property cash out of their own pocket? And even if you could, it would be stupid to put so much of your money into it. I mean, you're getting a loan for about 1% now, and it's also tax deductible. That's free money as far as I'm concerned. You also have the so-called incidental rental costs, like the property management company, maintenance costs for renovations, and another big one is depreciation. From a tax perspective, a property loses 2% of its value every year. So after 50 years of wear and tear, the property is basically worthless from a tax perspective. Therefore, it is extremely worth it if you buy real estate to have a high property value and a low ground value in the purchase agreement. Because Finanzamt says that only properties depreciate in value, ground doesn't. So please consider this before you buy something, because this little move can save you tens of thousands of euros over the next 50 years. Let's stay with the safety and return side of the magic triangle, pensions. The government wants us to save for retirement, because when we get old, we could be an expensive problem for them. That's why all pensions offer some kind of tax benefits. That's Angela Merkel telling you to save some money right there. Our German pension system is built in 3 levels. And everyone who's working as an employee has at least level 1, the public pension. When looking at pensions, we have to differentiate between pay-in and pay-out phase. Level 1 is tax deductible during pay-in, so for all you employees out there, put it in your tax declaration, get your money back, because during payout, level 1 is taxed. Of course, I told you the state wants its share at some point. Same with level 2, no taxes during pay-in, so you have to pay taxes during payout. You might ask yourself now, what's the point of all this? I'm just postponing my tax bill. Kind of, but I'm rather paying taxes later than right now. And second, your tax rate is probably higher right now when you're working than later when you're in retirement. So you're saving this much taxes now and have to pay that much taxes later. Level 3 is different. Pay-in is not tax deductible and payout has tax benefits. But the answer is not that easy, because level 3 is the only level where you can decide if you want a lifelong pension or if you want a one-time sum of all the savings you accumulated over the decades. This can be a nice option for all you expats who want to go back to their home country in retirement. In this case, taxation depends on how old you are and how old your pension contract is. Let's make an example with the best case scenario. Let's say you want to retire tomorrow and your level 3 pension has a value of 100,000 euro that you want as a one-time sum. Good for you, these 100,000 euro are not taxed as a whole. First, we have to calculate what you put in. Let's say you paid in 30,000 euros over the years. So your profit is only 70,000 euros. Out of these 70,000, only half of that is taxed. That's the benefit of level 3. So 35,000 euros is taxed with your personal marginal tax rate. Let's say it's 30%. Then you would have to pay 10,500 euro in taxes and would get almost 90,000 as a net payout. That's pretty nice. If you choose the lifelong pension, the taxes you have to pay each month depend on how old you are when you get the payout. That calculation would blow this video way out of proportion. So if you want more details on all the different levels of our pension system, I mean, you're paying thousands of euros into the system, right? Let me know, drop a comment below, and I'll make a video explaining everything in detail. So tax benefits in either pay-in or payout are the first big advantage of pensions. Second benefit is, and we will see this shortly when we speak about the remaining investment options, every investment is usually taxed every single year that you hold this investment. Pensions are only taxed the moment you get money out of it. So if you make a pension today, invest in it until retirement, and then get money out, you don't pay anything to the German state until you retire. Not one single euro. In all the other remaining options on the safety and availability side and the availability and return side, bank accounts, fixed deposits, savings accounts, mutual funds, ETFs, you've seen the videos. You have a flat 25% tax rate plus solidarity tax plus church tax in case you're a member of the church. So fairly easy taxation rules compared to real estate or pensions. If you remember the quiz from a couple of weeks ago, the right answer was that you get 1 lousy euro per year in interest on a German bank account. Do you have to declare this 1 euro to Finanzamt now? Of course not. Not even us Germans are that strict. Because everyone with a German tax ID, so everyone, is allowed to make 801 euros in capital gains every year tax-free. And if you tell this your bank, they will not tax you until you make 801 euros in profits. For comparison, that would be 8 million on a bank account with the average German interest rate of 0.01% per year. Congrats if you have 8 million, not congrats if you have this money sleeping on a bank account, because then you are a stupid Steve. Put your money to work for f***'s sake. Last but not least, this week's quiz. We talked a lot about return and its diminishing factors like taxes and inflation. And in the beginning I said that some of you might think you have a return, but you don't. So what do you think? What rate of return do you need in order to have a real return on your investments? After inflation, taxes, fees, whatever. Is it A, 2%, B, 4%, or C, 6%? Let me know, drop a comment below, and I'll tell you what you need according to our calculations next week. Next week we're also talking about the Magic Fiveangle of investing, because there are actually 2 more important factors to consider. Just kidding. Next week we're talking about investing tips you might want to follow in order to become a financial success, and investing fails you definitely want to avoid the week after that, right before our secret last lesson. If you got any questions, write them with the hashtag AskPerFinEx in the comments. If we can help you with your financial future, scan the QR code and book a free 30-minute session with us. See you next week. Until then, don't pay too much taxes.